In the alternate version of exercise 12-8, we're asked to prepare the company's cash flow from financing activities. As you recall from reading the chapter, cash from financing activities falls into two broad categories, either related to long-term liabilities, like bonds payable or notes payable. Your chapter talks about there's an exception. It might also be the current portion related to bonds and notes payable, so make sure you read through those exceptions. The other major category is cash impact of equity. So let's go ahead and jump in and figure out which items affect financing, and if they do, what the cash impact of those are. So we'll start out our cash flows from financing. A indicates net income was $473,000. Now, that does appear somewhere on the statement of cash flow, but just not in the financing section. Net income is a normal part of our operations, so it did appear in our operating activity section if we use the indirect method. Remember, we start out with net income and list all our reconciling items in order to get to cash basis of what our operating activities are. It just doesn't appear in our financing section. B, we're going to issue common stock for $73,000 worth of cash. We're issuing equity. This is equity within the company, so it definitely fits within financing. Proceeds for issuance of common stock. Keep in mind the company is receiving cash in exchange for giving up ownership interests, so we're going to show an inflow of $73,000. Now I will note this could change somewhat if the transaction changed a little bit. What if the company issued common stock in exchange for equipment? Well, there's still a financing angle, correct? Because common stock is still being issued, but on the other hand, it doesn't have a cash impact. There's also an investing angle. The company is acquiring equipment. That's an investment, correct? It's a long-term asset. The problem is it doesn't really fit within financing, and it doesn't really fit within investing because while it is an activity related to that, it doesn't have a cash impact. So you can't really put it in the body of the statement of cash flow. Because it's a significant non-cash investing and financing activity, this company would either put it in the notes to the financial statement or have a separate section that listed non-cash investing and financing activities. So let's look at C. We're going to pay a cash dividend of $11,000. That's an activity related to financing of the company. Keep in mind, our owners have either common stock or preferred stock within the company, have an equity interest. Dividends are just a distribution related to that equity interest. So we would list paid cash dividends within our financing section. It's an outflow of cash, so we'll show that as a negative $11,000. I will note again, similar to B, what if I change this transaction a little bit and instead of paying dividends to our stockholders, what if this company owns stock in perhaps another company and so periodically got dividend income related to that ownership interest or that investment in another company? That dividend income wouldn't be financing related, it would actually be operating related, so it would appear in our operating activities section. So keep in mind, sometimes when we see the terms like dividend, we start to jump to one section or another. Make sure this is a payment of a dividend to our stockholders, which is financing, but a cash dividend, a receipt of cash related to an investment that this company would have, would be an operating activity. So we're going to move on to our next one in line. We're going to pay $130,000 cash to settle notes payable at its $130,000 maturity value. So notes payable, long-term liability, definitely a financing activity. Repay note payable, we're paying out the $130,000, so we'll show this as a negative $130,000. E, they're going to pay $116,000 cash to acquire its treasury stock. If you recall, treasury stock is simply stock, either common or preferred stock that had previously been in the hands of stockholders that the company buys back. That's equity related, so it's definitely going to be a financing activity, purchase treasury stock. It's an outflow of cash, so we're again going to show a negative, this time of $116,000. Last and not least is going to be F. We purchase equipment for $90,000 worth of cash. Well, that goes somewhere within our statement of cash flow because it has a cash impact, just not in financing. It would actually go within our investing section. So we can ignore that as far as financing. So let's go ahead and look at either our net cash either used or that comes from our financing activities and go ahead and total this up. $73,000 from the issuance of common stock, a payment of cash dividends of $11,000, a payment of notes payable of $130,000, and a purchase of treasury stock of $116,000 means that we have a negative outflow in financing. So they put more out in financing that they received in, a negative $184,000 for financing. Because of the fact it's an outflow, we title it as net cash used by financing activities.